coming. In this paper, my co-author and I study the effects of having multiple and simultaneous central bank policies in a unified framework. And I'll argue throughout the presentation that a key feature of our identification strategy was to match the actions of monetary authorities with their stated targets and other observable covariates. So, in other words, it was very important for us to see what they did and what they saw with a clear timing profile. Again, our objective is to allow for a multivariate policy model in which policy instruments are governed by dependent decision processes. To do that, we try to model policy in a very precise way using high-frequency data. And we finally allow for nonlinearities when extracting or purging the unexpected component of policy. And as a flash forward to the end of my presentation, we find two main things. Our first result is that the price puzzle, which means that there's a positive relationship between interest rates and prices, disappears when accounting for the systematic responses to the economy. And the second result is that while unannounced foreign exchange interventions have a significant effect on reducing exchange rate volatility, announced interventions appear to have a significant effect on both the level and volatility of exchange rates. Right, so ever since the end of the Bretton Woods system in the 1970s, many emerging economies who claim to have a floating exchange rate don't really float. And the Turkish case is no exception. And after the East Asia crisis of the 1990s, the corner or bipolar hypothesis that postulates that countries are moving from intermediate regimes towards either hard pegs or fully flexible rates began to lose popularity. And since then, what we see is that there's many central banks who allegedly opt for monetary policy autonomy, but that they've been reluctant to give up control over the value of their currencies. In fact, industrialized countries have led a number of concerted initiatives, such as the Smithsonian Agreement, the Plaza and Louvre Accord, the Chiang Mai Initiative, and the Pittsburgh Agreement. Emerging markets also frequently intervene in the foreign exchange market, but in less coordinated fashion. Now, in international finance, the impossible trinity or trilemma indicates that a country cannot simultaneously allow for free capital flows, have autonomous monetary policy, and adopt a fixed exchange rate due to arbitrage by foreign investors. But again, what we see is that there's a lot of countries trying to target all of them. So it does raise the question of whether central banks are being maybe overly ambitious. The trilemma can be exemplified very simply in an economy with an uncovered interest rate parity condition, an IS curve, and a Phillips curve. In the moment in which a country decides to fix its exchange rate, then it automatically loses its monetary policy autonomy. It cannot set interest rates freely. Its output is only going to depend on foreign factors, and its inflation is going to depend on going to be driven by market expectations only, and not by central bank decisions. So this is, I think, part of why there's been a lack of a general consensus in the literature on the effects of foreign exchange interventions in particular. Recent surveys basically show that half of studies find significant effects of foreign exchange interventions. Only a handful of studies actually address the issue of having multiple policy instruments, few which estimate their dependence, and none of which center the Turkish economy, which is where we center our investigation. So in the Turkish Central Bank conducted foreign exchange intervention in various ways. One was through unannounced interventions, often infrequent but very large. It's depicted in the graph to the left, in which interventions may be varied across $4 to $6 billion in one day, and also through announced interventions, which is depicted on the graph to the right, which consisted of predetermined dates and amounts, except for maybe an optional component, provided that monetary authorities decided to exceed the established amount. That's the gray bars. Now, concurrently, the central bank also adopted an inflation targeting regime in 2002. The reason why we limit our sample up until 2010 is because after 2010, the Central Bank of Turkey also implemented various instruments, which include an interest rate corridor and a reserve option mechanism, and we feel that further assumptions are required in order to disentangle the effects of a particular policy. So again, before going into the regression-based setting, let me just say that there's usually three main endogeneity problems that people face when analyzing the effects of policy. The first one is not being able to precisely observe the decisions of monetary authorities, leading to a measurement error. There could be a simultaneity bias. Central banks react to economic conditions, and at the same time, economic conditions react to central bank interventions. And finally, you might fail to capture the relevant variables to model policy, so an omitted variable bias. In this paper, we address 1 and 3 with the variables comprised in our data set, and we address 2 with the high frequency of our data. So we propose an economy described by a stochastic process comprised of 3 main vectors: a vector of outcome variables, yt, a vector of exogenous variables, xt, and a vector of policy instruments, dt, so 2 for the Turkish case, which are foreign exchange interventions and interest rate interventions. The relevant history at a given time, t, is going to be described by z of t, that for a given mapping, phi, is going to depend on the histories of the three vectors. And what you're left is with a policy setting equation that is going to be comprised of 2 parts. One part of a deterministic component of policy. So this term is going to capture everything that the central bank saw when making their decisions, and with a component of idiosyncratic shocks, which are going to be the policy shocks that we estimate, and we estimate their effects on the economy. Now, if we defined y psi of d as a future value of an outcome variable for a given realization of policy, then the conditional independence assumption, the CIA, which is not what the people think it is, states that conditional on the relevant history, policy decisions are orthogonal to potential outcomes or as good as randomly assigned. And that's really the foundation in which we can use regressions to approximate experiments in the absence of random assignments. And it's particularly useful when counterfactual outcomes cannot be observed. And so what would have occurred if the central bank had purchased $30 million when it actually purchased 50, or what would have occurred if it didn't intervene given that it actually did. So the resulting bias when computing the conditional mean of an outcome variable for different levels of intervention disappears once you introduce the relevant history in ZT. Now, the fact that you see many instances in which the central bank purchased foreign currency, dollars, and very few instances in which it sold dollars, leads to 2 possible explanations. The first one is that the bank found it optimal not to sell many dollars, or the second one is that the central bank wanted to sell dollars but couldn't because of an exterior constraint. And many of the literature refer to this external constraint as a fear of floating or a fear of appreciation. And authors include Calvo, Reinhardt, Yati, Levy, etc. So what we do is we actually model the second scenario in which there could have been some censoring in the data by adopting a TOBIT type 1 model and including it into the bivariate process. And we also model the case in which there isn't a censoring in the data by just modeling a joint normal distribution between foreign exchange interventions and interest rate interventions. So going very quickly through this is basically the two policy rules if policies were independent, so they would follow two univariate processes. Again, this is going to be the case in which the data is censored, and just we assume a linear representation for the interest rate policy function. Now, to compute the policy shocks, you need to subtract the conditional mean of policy from its observed value. And that's going to be trivial for the case of the interest rate interventions that follows from linearity, and it's not going to be that trivial for foreign exchange interventions, in which you're left with a term that represents the probability of a positive intervention, and then the terms in brackets is just the expected value of the latent variable, and some of you might recognize this last term as the inverse Mills ratio. Now again, there's no reason to believe that the policies were independent, so we also allow for some covariance between the two policy rules captured by sigma 1, 2, and the sigma 1, 2, which is going to be the covariance between the residuals of both policy rules, can be parametrically tested by constructing a maximum likelihood function in two stages. The first one for uncensored observations, in which you're left with a conditional distribution of foreign exchange interventions times the marginal of the interest rate interventions, and a second step for censored observations, in which the mass of the foreign exchange distribution collapses at 0, and you're going to be left with a truncated bivariate normal of foreign exchange interventions again times the marginal. So combining both, you're left with this very messy expression, but fortunately it's extremely easy to estimate in any statistical package. Let me just quickly say that for the impulse response functions, we followed the methodology in Romer and Romer, and also the methodology of local projections in Jordan. Our findings seem to be pretty robust across different ways of computing the impulse response function. So let me just quickly go through some of the results. This table shows the foreign exchange intervention policy rule, so for the different types of intervention. So the Central Bank of Turkey purchased dollars, wanting to depreciate the lira whenever the lira appreciated, whenever exchange rate volatility was high, and it also reacted to inflation minus its yearly target, as well as lagged policy rate changes. This table represents the other policy function, the interest rate policy function, and what it shows is that the Central Bank of Turkey conducted contractionary monetary policy, raised interest rates whenever inflation was high and whenever the lira was depreciating, and it conducted contractionary monetary policy whenever global financial conditions were very volatile, again captured by the VIX index. This is a slide that shows you the estimated residuals, our version of the policy shocks compared to the actual interventions. And what you can see is that both are extremely different, even more different than what we expected. The difference between the green and the red is exactly the deterministic component of policy. So in many instances, there were many factors in the economy that explain most of why the central bank intervened, both through interest rates or through foreign exchange intervention. And as an additional exercise to the paper, what we did was we graphed an impulse response function that I'm showing here is the responses of inflation to a given shock in interest rates. The first graph shows a shock in the actual interest rate, so just seeing the effect of an interest rate hike and what happens to inflation. And what you can see here is exactly the evidence of the price puzzle, in which again interest rates and prices are positively related. This relationship disappears once you account for the systematic responses of policy, once we use the estimated residual that we propose in the paper. And what it actually shows is quite the opposite. You see sort of a negative trend, which is what you would expect, only significant though in months 9 to 12. This last slide basically just gives the summary of all of our results. So what we find is, using only the estimated residuals in the way I just described, what we find is that foreign exchange interventions do not have an effect on inflation or output. This is actually one small typo. This should be a plus. So what we find again is that the announced purchases of dollars depreciate the currency as expected, although very short-lived, for only less than 2 months. And it also reduces exchange rate volatility, but again, only for a period of a month. Interest rate intervention shocks, on the other hand, do not have any effect over exchange rate volatility, but they do reduce inflation, output, and the exchange rate. Thank you.